Perfect, perfect. So, good afternoon, good morning, good evening, wherever you're listening from and watching from. I am Dominique Anderson, principal at Populous Community Strategy. We are a consultancy that focuses on real estate development and community development with a special focus and passion for affordable housing and community improving real estate. Today, I get to talk about one of my most favorite things in the whole world, which is, of course, affordable housing and how do we get there, because we talk about the shortage and the lack thereof, and there's so many ways to get to the end result and the end goal, which is affordable housing. And so to that end, I want to introduce my guest. I want him to actually introduce himself and tell us about what he does and how he got here. And with that, I will give it to you.
All right. Happy to be on. Thanks, Dominique, for inviting me. I'm glad we're able to get on and be able to do this. So
Yes.
my name is Sitta Dumbuya, born and raised in Atlanta, the lovely city of Atlanta. And actually been in multifamily for a little over 4 years, been in real estate for about six. And mostly what I've done in multifamily has been acquisitions consulting. And through my partnership with Real Apartments, got into affordable housing a few years ago. And with affordable housing, we play in the preservation space. So a lot of affordable housing development is like ground up, new construction. But we're in that space, that particular niche where we take properties that already exist and we look to preserve affordable housing in those units. So it might be naturally occurring affordable housing, or it might be a light tech deal where the tax credits are running out of their timeline, of their compliance period, or whatever the case. But we look to take existing properties and just keep that affordability in place, because it's like a hole in the bucket. We can keep building more and more affordable housing, but if we're losing the affordable housing that already exists, then we'll never be able to reach our goals of being able to provide enough affordable housing stock.
I love that. You said something, a couple of things. Our audience, my audience is a little bit wide. I really have a lot of developers, a lot of market rate developers who want to get into affordable housing, but we also have a lot of emerging and aspiring small scale developers. And so when we talk about, I want to make sure I just did a in our group coaching yesterday, I was telling them that we throw a lot of acronyms at people, right? And in real estate, we talk a whole lot of acronyms. And in affordable
Yeah.
housing, we talk a whole lot of acronyms, right? AMI and LIHTC, and then just kind of terms. So you mentioned naturally occurring affordable. So for those individuals who may not know what that means, what's the difference? Is are all buildings naturally occurring
Right.
affordable? How do we get there? What does that mean?
Yeah, no, that's a good question. Affordable housing is going to be based on, what can somebody afford? And that's typically defined as 30% of their gross income being spent on housing. Now, in most cases, when you're a developer and you're going to be building, you're not going to build affordable housing, because now you're going to be rent restricted. Your revenue on the back end is going to be restricted, even though the cost to construct the building is going to be the same as if you did market rate. So in most cases, properties that are affordable are going to have some kind of government subsidy, or maybe even like a nonprofit partnership, something in place that allows the developer to lower the amount to build so that they can keep the rents lower. Naturally occurring affordable has no type of subsidy. That's why they call it naturally occurring. And most of the time, that's going to be older properties that they're just not up to date. They're not renovated, so they can't get the same amount of rent as some of the higher end, nicer projects. So that's what they mean by naturally occurring affordable. There's no subsidy in place.
And so when you acquire these properties, you find them, they're naturally occurring, affordable, they're a more cost effective, I don't want to say cheaper, but they're more cost effective for you as an investor to acquire and then put money into it. What's that process look like for you once you find this multifamily unit and you say, okay, this is great. It's a great price. I can occur. It's naturally occurring affordable. Now you've acquired this property. How does that become affordable housing? Because you're putting money into it to fix it up, correct?
Yes, Noah actually a lot of times people are going to take NOAA deals and then put an affordable component on it. So, for instance, there's one deal that we got. It's an older property, needs work, a little bit of distress. So I would consider that naturally occurring. The rents that are in place are already like 60% or below 60% of the area median income. Now with that, the biggest thing is just being able to buy at the right basis. And by basis for newer developers and newer investors, that means the cash that you have in. So you have buy at a lower price point, that means your basis is lower. And that's going to be the most important thing because if you can buy at a lower basis, even if you put a little money in, then you're still at a lower price point to where on the back end you can keep rents lower and it can still make sense because everything is going to be based on ROI or some other return metric, which is going to be based on how much money you put in the beginning. So if you want to do a NOAA deal, the first thing you have to do is just find the right basis. And then a lot of times you may need to partner with a housing authority or with a nonprofit that may be able to give you some free equity, which is going to allow you to keep your basis lower and then keep it affordable.
Okay, perfect. And so, just want to drop in. You hear him saying NOAA, naturally occurring affordable housing.
Yeah.
Just want to make sure everybody's clear there. If you're from Nashville, you'll hear NOAA, and you may think of the Nashville Organization for Affordable Housing, right? So they're a NOAA as
Mm.
well. And I think there's some other NOAAs, but for all intents and purposes, on these conversations, that's what NOAA stands for. And so you dropped in a couple things. One was partnerships with the housing authorities, and then the other was free equity. What is that? How do we get that? How do we get this? We like free things. What's the free equity? And how does the housing authority play into that?
Yes, if unless you live under a rock, you know that we're in the affordable housing crisis nationwide, and then that means the government is stepping in because as I mentioned earlier, developers in the private sector they're just not going to be able to or not going to be incentivized to create affordable housing. So the government a lot of times is going to get involved. Now, they can get involved in a lot of different ways. So we talked about LIHTC, and I'm sure you're going to ask some questions about that later. But there are a lot of different ways you can play into it. You can work with housing authorities, nonprofits, and a lot of times because they're the government that has a directive to create affordable housing for their community, they'll be looking to partner with you financially. So one way they may do that might be a pilot program. So pilot stands for payment in lieu of taxes. So that's one way where you can have a tax structure that allows you to lower your cost basis so you can keep rents affordable. Then they also have a tax abatement where you might get 50% off of the taxes for your property for the first year, and then a lot of times they have a step up, so it might be like 50% reduction the first year, then a 45% discount, 40% discount, so on and so forth. But being able to lower your tax bill, that's going to be one of the most common tools that local governments and housing authorities are going to be able to use to be able to help you in creating affordable housing. Then there may also be grant funding. In Atlanta, we have a few different things. We have Atlanta Housing. They have what's called the Home Flex program, where they'll actually pay a lot of the tenants' rents, and it may be even more than what they can afford based on AMI. Then we also have Invest Atlanta, where they're willing to dedicate funds to your project to be able to help lower your basis so you can create affordable housing. So it's all about tapping in, getting involved at the local level, and seeing what groups, what organizations, and what tools you have at your disposal to be able to create affordable housing. But I can warn you, it is not an easy process. It's very painful. You have to go to a lot of meetings. You got to shake a lot of hands, kiss some babies. You got to do a lot of things to be able to get these
Yes.
funds into your project. But if you can make it work, then it's a great way for you to provide affordable housing.
Mm, you took the question right out of my mouth. And so when we talk about these partnerships, so in community development, community engagement, I shake a lot of hands and kiss a lot of babies. And I tell everybody, listen, I do two things at an expert level: words and relationships.
Yeah.
Other than that, like all the other skills, we fill those in, right? But that's
Hmm.
what I really do well. and wound up for somebody who went to college, opened a catalog, and said, "What doesn't take math? I'll do any of that." And so that's where we start. But now you find yourself in this world that if you don't understand and speak about low income housing tax credits and new market tax credits and abatement and pilots and all these things that I never ever thought that I would talk about or know, you have to understand these things. But what you also have to understand is partnerships. So I'm going to back you up a little bit. You have to have these housing authority partnerships. You have to know your council people. You go to a lot of meetings. So you mentioned that. Where do you show up? How do you start building these relationships? Where do you show up?
Yeah, it is at those meetings. We've been to, for us, because we look at throughout Metro Atlanta, and we've gone to several economic development meetings. So, like City of South Fulton, we've met with their economic development head. We have a property in Douglasville, a 100-unit lot tech deal that we're looking for some support on our recent application. We've been to their meetings, their city council meetings, and everything. We've been to Atlanta housing meetings, just sitting in on the board, having meetings. And going up, just talking to people. Like we have a relationship with someone at Atlanta Housing that I literally met just by going and sitting on their meeting and then talking to them afterward, exchanging cards and then getting on a call. And we've developed that relationship over the past few years. So it's to the point where like he's championing us. He wants to see us succeed in closing deals. So we see him at all these economic development meetings, all these different conferences that deal with affordable housing, and it's just really building a relationship over time. And the biggest thing when it comes to these relationships, yes, you go to the meetings, yes, you show up. First thing is being present. Showing up is like a big part of it. A lot of people aren't going to show up to those meetings and they're not going to follow up. So showing up is a big thing. Second, you got to be authentic. People can tell if you just want something from them, if you're just trying to make a buck off of development. People can tell that, they can sense that. So you got to be authentic with what your mission is, and then also be authentic about wanting to get to know the person. You guys have that in common. They want to see affordable housing being created. You want to create affordable housing. You have that bond, but you still need to look past that and really be able to understand the person and build that relationship. And then it's just like consistency, consistency, consistency. It's not going to work after the first meeting or the first interaction, but once they see that you're coming back, being consistent, trying to get into different avenues, asking questions, then you'll really garner their support over the years.
Okay. And that's so don't show up thirsty, right? Like how do
Yeah,
you not seem thirsty and desperate, and how do you also not just me, I give, right? Like how do you take? How do you not do that? How do you give? Is the thing that people, when you do this work, you have to start there, right? How am I
yeah,
looking outside instead of inside first? Because it's never you're going to hit that wall every time. Would you say that's right? You feel good about that?
yeah, yeah. No, I agree 100%. I think and that's one of the biggest things is in any type of relationship. I think a great way is asking questions rather than trying to tell people what you want. Asking questions about what it is they need, what challenges they're seeing, and really being curious, I think is a great way to not seem thirsty. More so, you're looking at it from perspective of how do we collectively solve the problem as opposed to how do I create more affordable housing. When you approach it from that perspective, you get a lot more traction and a lot more leaning in from the people that you need it from most.
I love it. I love it. So that's if you're gonna go into this work, right? Like it's not about you, it's about the end goal, it's about the people. How did you get here? Right? Like how did you even start doing this work? Is this like family? What tell us about that.
Yeah, so yeah, my path through real estate is I'll say it's pretty different from most. Like, it's very common that somebody reaches rich dad, poor dad. They may be working like as a engineer, consultant, something. They read rich dad, poor dad, and like, oh, I want to get out the rat race. Let me start doing real estate, get some rental properties. My path was different in that like I'm from Atlanta. I was born and raised in Atlanta, grew up on the east side. And I've been here since forever, but my family's from Sierra Leone, West Africa. So that in itself was a big driver for me to get into real estate. because the first time that I remember going back there when I was in high school, noticed there was a lack of development. And there were people that were developing, a few people, but most of them weren't, locals. They weren't actual Sierra Leonean. They may have lived there for generations, but they weren't Sierra Leonean people, if you get what I'm saying. So
Right.
you get a lot of foreign investors, a lot of foreign developers, and then when you, at least in my opinion, if you are a developer at that scale, like you're doing large scale commercial
Hmm.
real estate, and you have no attachment to the community, then the community itself never benefits from whatever it is you create. The area improves, but the people don't really see the value in that. So I wanted to learn commercial real estate for that specific reason, so I could be able to have an impact, where I'm from and all of that. So I didn't really want to get into building a single family portfolio. I always want to do commercial real estate. I always want to do larger projects.
Hmm.
So when I was working as an engineer, started learning real estate in general, and then I got into my first investment property, which is a couple units fixed up, house hacking. And in that process, that's when I started learning how to analyze and underwrite multifamily and started learning about the business, learning about acquisitions, raising capital, asset management, started learning about the business, and then started working with some more experienced investors once I got comfortable with my underwriting skills and just pretty much underwrote. What I tell people getting into this industry, you don't need to know everything. You shouldn't try to know everything, at least not immediately. You should pick one skill, one way that you can add value and become proficient in that. That's going to be the biggest thing. Learn one skill, be great at it, because then you can fast track your growth in that one area because you have focus as opposed to trying to learn everything. And then, as we mentioned before, this is a team sport. It's about partnership and relationships. If you have one way that you're very good at doing something, and you're able to build relationships, you can find the complementary skills. And because you're proficient, you can find other stars who are proficient at what they do. And now you can collectively come together and be able to get a project done. So that's how I got into it, just by learning how to underwrite, analyze deals, pretty much just for free. Just had a whole second job outside of my engineering job, just underwriting deals as part of this partnership until we actually closed something. And that was a few years ago. It was a market rate deal. It was a 102 unit, $17 million deal in Virginia Beach.
Awesome.
To this day, I've never been to Virginia Beach. And then that's shortly after that is when I started working with my current partner, Jason. And that's when we moved into affordable housing and focusing on LIHTC tech deals, NOAA deals, and affordable housing preservation.
Awesome. Awesome. I like that you said, you, A, I know all about people moving in, building things, and
Okay.
not really feeding the community. I'm from Nashville, so clearly I
Yeah,
know all about it. The whole
right.
world has moved to Nashville, and there's a crane on every corner. And so it seems like every second of every day, something new is being built, pops up, but the community is still not, they're not benefiting from it the way that it was portrayed to be benefiting from. When you do, so that leads me to the question, like when you do your deals from the community aspect, what does your community engagement process look like? A, and then B, what type of, if there is a lot of pushback, how do you handle that, any type of community pushback from the projects that you work on?
Yeah, so I would say the first thing, because we're in the preservation space, is not as
Mhm.
big of an issue.
Right.
A lot of times that community pushback comes when you're doing development, because now you're about to do this whole project and throw up some housing and
Right.
put people in this location that, there weren't people there before. So it's not as much of an issue, but for us, we like to add value outside of just providing a place to stay and collecting the check. Affordable housing it can be limited. It can be a trap in a sense because
Hmm.
you're paying this very low rent, but only because you make a little amount of money. Now you
Correct.
can make marginally more money, but now you're just over that limit or a little over that limit. Now you can no
Hmm.
longer qualify for affordable housing.
Hmm.
But now your rent, your housing costs might be twice as much, even though you're only making like 10% more income. So then it's like people try to hover, around
Right.
that max. So it's like, how do you economically mobilize people to get to a different place in life where they can move out of affordable housing and still be fine, still be better off because they've economically, improved to such a level. We like to see how we can impact that. So one of the things we're doing on our Douglasville property is bringing in financial literacy courses. So we have somebody who goes around different apartment complexes and will do these financial literacy classes like once a month.
Mhm.
Just be able to add something that's going to help the people in that community that just may not have ever been exposed to different ways to look at money that might have a big impact on them. Then also getting involved with the city and the government, like going to Douglasville town hall meetings, their city council meetings, speaking with their city council, and they'll have feedback from us like, oh, XYZ is going on at this property, or we want to see XYZ. So getting their buy-in and implementing some of their suggestions as well. I think that's a big part of it. So just seeing what you can add value in that's gonna go beyond just providing housing, and then actually listening to the people in that community and what they want to see.
That makes a lot of sense, and that's super helpful because I think when we think about affordable housing and individuals, there's always the first pushback, right? No.
Yeah.
So what you're providing is you're creating healthier, safer living places that are affordable for the residents that live there. Are they typically already occupied when you do your work, or are they usually vacant, or what does that look like?
Yeah, we'll typically buy properties that are already pretty well occupied. And typically do a renovation on it, so improve the community. One thing that we've done in the past that we're working on now actually is the resyndication for LIHTC credits.
Okay.
LIHTC, of course, is the low income housing tax credit.
Hmm.
So it's a federally funded program that's allocated at the state level to provide affordable housing, either ground up construction or preservation and improving existing affordable housing properties. So for us, we like to resyndicate. So tax credits have like a 30-year time period where the property is going to remain affordable. And then once that 30-year period is up, you can start transitioning it to be market rate and you can charge whatever. So
Hmm.
for us, we want to preserve that. So we'll take a property that was LIHTC, the credits are running out, and then we'll resyndicate. So we'll apply for more tax credits, which will give us funds to redevelop that property, and then it also extends the time period, those 30 years, so it restarts the clock of affordability. And with that, we can redevelop the property. There ought to be people in place. We have to work through, relocating them and moving them around as we go through and renovate each building on the property.
Hmm.
But the end result is you get a pretty much brand new. It's like they want you to really put a lot of money into fixing these units up. So it'll be pretty much brand new property, while at the same time you keep it affordable for the people that live there.
Okay. And so re-syndication, let's talk a little bit about, let's go down the rabbit hole with numbers and a little bit of money, right?
Yeah.
Um, so we talked about LIHTC, low income housing tax credits, and that is only for residential, right? We could get into new market tax credits, but that's a whole nother thing, and that's for commercial. Do you do anything with new market tax credits?
I'm actually consulting on a development project using new markets right
Hmm.
now. We're slated to close by next month.
Okay.
It's a pretty big project in South Georgia.
Very good, very good. And so we're Populous is hosting. I'm doing a kind of a small workshop, or not small, but a workshop on LIHTC versus New Market in plain English, right? And I definitely want everybody that has no idea what that means to show up. And I promise not to use a thousand pieces of jargon. I watched a really great video the other day. I do my research on other individuals and kind of what's resonating, and there was a ton of just jargon, and if you didn't speak it, you're going to glaze over and get lost. And I speak it, and I was like, wait, back up. So when you talk about these LIHTC deals, first of all, how do you find these deals? Where do you find your deals? Do they come to you? Do you go to them? Is there a marketplace? Let's talk about that a little bit.
Yeah, in commercial space in general, once you get over like 50 to 60 units, pretty much all your deals are going to go through brokers. Like in the single family, if you're coming from single family, you may be more familiar with like direct to seller, doing different types of marketing where you can find off-market deals. That's not going to happen as much when you're dealing with a large apartment complex. So you really have to work hard to build relationships with brokers for the most part. We connect with all the major brokers from Cushman Wakefield, Berkadia, Franklin Street, Marcus and Millichap, you name it. We have connections with every broker that is going to be trading deals in Georgia, Tennessee, South Carolina. So that's where we get most of our deals from. We also have worked hard to build relationships to be able to source off-market deals, and that's even more tricky. Like you got to know the right people to be able to get those, especially if you want those large deals. I got a connection that, we can get like 300, 400 unit deals off market. But for the most part, you go through brokers to get the deals.
So you're the plug. You got the plug. Okay, got it. Check. So if you're looking
Got
for
a few.
really awesome things, you need to call Sita because he has everything. Um, okay, okay, good. And so when we think about Litex, that's how you do that. We talked about resyndication. What's the first part of syndication? If it's we're doing it again. So
Yeah.
open that up a little bit about that syndicated deal when it comes to the Litex.
Yeah, so it's the same thing essentially. Just syndication is when you're going to build it for the first time, whereas
Mm-hmm.
resyndication is a deal that's coming out of compliance that you want to put back into the program. So you're applying for tax credits again. And the way the tax credits work is there's a application process in Georgia. So there's two. There's the 4% and the 9%. The 9% gives you more funding. The 4% at one point was not competitive. So pretty much if you had a
Mm-hmm.
project that qualified, you were gonna get your 4% tax credits. And 9% has always been competitive, meaning you're gonna be going against other developers. They're gonna score you, and then whoever has the better scores, they're gonna get the funding. And as of 2022, the 4% has also become competitive. So you can apply for the 4% and not get it. That's in the state of Georgia. And every state is going to do something different. You have to
Mm-hmm.
look at what's called the QAP, the Qualified Allocation Plan, which is
Mm-hmm.
going to spell out how your state is going to allocate those tax credits. So in Georgia, the 4% round is in October, the 9% is in May. So you have to go through this process of submitting your application into that round, and it's costly. It's costly, it takes a lot of work. You're gonna have to do some third party reports and surveys, and as soon as you say that it's for tax credits or anything like that, it's gonna be a lot more expensive, whatever it is you get. So you go through that process, and then if they score your project based on the application, and then they rank you, and then they distribute funding. Now, if you get funded in October, you'll find out or you apply in October, you'll find out in March, and then later that year, at the end of the year, is when you get funding. The way it works is you get the tax credits, and you as a developer can't really do anything with the tax credits. So you're gonna sell those tax credits for about 80 to 85 cents on the dollar to a tax credit equity investor, and that equity investor is gonna give you those funds in exchange for those tax credits, and then you use those funds as part of the development to be able to lower your basis. So that's the whole process and very, very high level. You get the tax credits, sell them, then use the funding to do your development.
Where do you find your investors? Where do you find how does if you're starting in this space and you want to go, you want to syndicate this deal, right? You want to sell this off to a tax credit investor. Where do you find those? Is there a network? Is there a website? Is there a group? Like where do you find these individuals that are going to buy these tax credits?
Yeah, so you'll find them at the same places where if you're trying to put together a tax credit application, you probably will end up in those rooms anyway. So like in Georgia, there's a Georgia Affordable Housing Coalition. They
Mm-hmm.
have an annual meeting every summer, and then they have a conference every March in Savannah. So if you're doing tax credit deals in Georgia, you're going to end up at one or both of those networking opportunities, and you'll find other syndicators or the equity syndicators. Everybody dealing with tax credits is going to be there. Like
Mm-hmm.
so, you would have to work hard to not meet one if you go to those. And then just as you build relationships throughout. networking. You're gonna have to build relationships with equity. You're gonna have to build relationships with debt. If you tell anybody that you're dealing with tax credits, then they're gonna start pointing you like, oh, we have this tax credit arm of our lender XYZ. Is if you're in the space, you would probably find the syndicator before you're actually able to successfully do a deal. So it's gonna happen. It's something you need, but like it's well before you actually need it. You actually make those connections.
So, this is a conversation that I had recently about syndicators, right? And I had someone say, well, just ask me, why don't you do more syndication, or why don't you start syndicating deals? Because that's another shiny ball, right? Like, it's trying to stay focused on the
Yeah.
thing, but you ultimately wind up doing this, and especially in my role. What makes a good relationship for you with a syndicator? What makes a good syndicator for you?
Like for the equity syndicator for like the tax credit
Hmm.
specifically.
Yeah, tax credit specifically.
That's a good question. We haven't even got that far yet. So we're working on our first LIHTC deal. Um, but we haven't successfully got credits. Fingers crossed, we just submitted an application last month.
Yeah.
So
Okay.
hopefully that one works well. So we've met with syndicators before,
Hmm.
but just haven't got that deep into it to really say we want to go with one or the other. So it's tough for me to answer that question. But I know we will have to cross that bridge eventually. Hopefully, soon we get these tax credits, then we have to cross
Yeah.
that bridge. So, I mean, more or less, I think a lot of times in the industry is going to be what the product, the pricing they're offering is going to be similar. There's going to be very few that are just, well, much better than others.
Hmm.
But a lot of it is going to be what kind of value can they provide? What kind of strategy, input, kind of service they're going to be able to provide to help you execute the deal in whatever fashion. So that's
Hmm.
one thing we look at. It's not always just about who's the best price, but who's more attentive, who do we feel like is going to give our project the care it needs and give us the attention we need to be successful.
Okay, that makes a lot of sense. And so, if there's anybody out there that may be toying with the idea of becoming a syndicator, right? Like, learn this side. This is important. When it comes to working with your team, are you local? Are there people that you take outside of your, state? Is it better if you're trying to, start doing this? Should you build a local team? Can you build a national, international? What does that look like for you all?
Yeah, so as far as team, we are at least the main partners, me and Jason are both local. That helps a lot. We do have, we'll have like interns, virtual assistants that are not local. It works fine for what they're doing. As far as building a team, you need to build a team. You need to at least have one person that's local to the market you're trying to invest in, at least
Mhm.
at a minimum. Ideally, you would want to have the focus there, but it depends on just what works for you when you're doing like development. Real estate in general is like hands on. You got to be present at these meetings, be present at networking events, be present at the property, and you're doing the development. So it's best to have a good number of people and different touch points in the market where you're developing. Now, you may be able to do some admin stuff and have somebody that's, from, in a different market if they're doing admin or even like investor relations. There's certain things that you can do and have people elsewhere. But if it's anybody that's going to be strictly or doing stuff on operations and acquisitions, then you want them to be local to wherever the market is, because that's going to be very important. They need to be present there.
Okay. And that's just, again, our audience is a little wide, and I like to always ask questions like,
Yeah.
how do you start? How do you get there? And so that's building your team. And then thinking about your first deal, right? Go back to in your mind to when you really started doing this work. What does that capital look like? Because we can talk about tax credits and creative financing, and we'll talk in just a minute a little bit about what other financing outside of LITech have you found? How do you fund these deals? But what is your out of pocket? I don't need exact numbers and expense, right? But I don't need a budget or a sheet or anything, a P&L. But what does that look like on the front end? Because a lot of developers don't start this work because of that front end capital they don't have. What does that front end capital look like when you start these deals?
Yeah, so for me particularly, I I invested like via sweat equity, so I didn't put any money in the first deal that I did. Also didn't get like a huge equity piece, but that's not why I did the deal. It was more so for the track record, proof of
Mm-hmm.
concept. As far as like what's typical for starting this deal, if you're gonna be partnering, like you're gonna have some co-GPs, because for us we syndicate, so we'll raise capital from limited partners, retail investors that just have equity and don't participate. Um, for us, usually our GP co-invest is gonna be 10% of the capital raised,
Mm-hmm.
or the total equity piece. So, for instance, that Douglasville deal we had to raise, or our total equity is like 2.3 million.
Mm-hmm.
So part of it is the GPs collectively put about, 200 grand in to invest alongside all of the limited partners that put their funds in.
Mm-hmm.
So, depending on the size of your deal and how much money you'll need in equity, I would say about like maybe 10% of that. And then also you gotta think about like risk capital too. So and that's usually factored into the equity. So
Mm-hmm.
risk capital, because you're gonna have to put money into the deal before you even know if there's a deal. You're gonna have to pay for some reports. You
Right.
have to pay some earnest money, which may be non-refundable. So and you have to pay for lawyers that draft your PSA and a syndication attorney. So I'll say just have about 10 to 15% of the equity you need for a project, and that should get you right. And to think about that from a macro perspective, if you got a $10 million project all in and you're getting about 55 to 6% loan to cost. So if you're all in project cost, you're getting about 60% of that, leaves
Mm-hmm.
about 4 million in
Right.
equity. So you're gonna need $4 million. So you might want to have about 400 grand between the general partnership to be able to fund your portion of the co-invest.
And so it sounds like, A, when you really start doing this work, you should, A, go out there and find your investors. That's crucial because if you don't have $400,000 in your pocket, the best thing to do is use other people's money, right?
Yeah.
And then let's say that you, again, this is a team sport, but let's say that you're not a team player and you want to do this by yourself, which I would never suggest. But if in fact you are and you're not necessarily bankable, let's say you're not going to go to the bank and get a loan for $400,000, are there other places when you say I'm doing affordable housing, and this is how I want to do this, and I need $400,000? Are there other places that you can go and get these funds that may not be? I mean, it's going to be debt capital for the most part, but are there other places that are doing, like in Atlanta, for example, for preservation? Are there organizations that are throwing money at you?
Yeah, if you're doing this by yourself, that's tough. Okay, yeah, I don't know. If you're doing this by yourself, you don't have the capital, because that would be my first suggestion. Like if that 400,000 GP portion of what you and the general partners, like you can have other general partners. Like if you have more knowledge and more expertise, then you can leverage that into the deal. If you have other partners who maybe want to be less hands-on, or they don't have the same knowledge but they have capital and they
Mm-hmm.
want to learn more, then you guys can partner together. It's a perfect marriage. As far as like just funding, is probably gonna have to be debt. Now you do want to make sure that that's smart debt. If you first you make sure you know what you're doing. Like you don't want to go and get a loan, get funding for a couple $100,000, $300,000, and you don't really know what you're doing. That's the first thing, and nobody's gonna give you that if you don't have a track record anyway.
Right.
But there are going to be funding sources that, we see a lot of lenders now, especially like if you're a minority, they may have a particular fund to help minorities, and it may be like pre-development capital, or they may be
Mm-hmm.
able to give you like working capital, just different things that you can use to get a deal going or get a deal started, and you may be able to use that, or it might be like a line of credit. But if you're trying to get debt for affordable housing, I would say try CDFIs. So
Mm-hmm.
those are going to be community development finance
Financial
institutions.
institutions.
Yeah,
Yeah.
yeah. So they're specifically for like impact funding, affordable housing, things of that nature. So you might be able to get qualified for funding that you wouldn't get qualified otherwise. The challenge with those, though, their pricing is variable by a lot. So
Mm-hmm.
they borrow money at a very low rate. So they can lend money at a very low rate, but
Mm-hmm.
they're not going to lend money at a very low rate if you come with a lot of risk, meaning
Right.
you don't have a track record. Like if you're the right person, like if you're Don Peebles, if you're
Right.
Egbert Perry, you might
Mm-hmm.
get a 3% loan from them. If you're Sitta Dumbuya and they don't know who you are,
Right.
it might be 7.5, it might be
Right.
8%. Like you might be getting a much higher rate.
And then
But
it's mezz
CDFIs,
funding. Right.
yeah, yeah. But
Mm-hmm.
CDFI is a little more, wow. CDFIs are definitely more flexible than your standard lender, and especially for affordable housing, they can give you some more flexible terms.
Yeah, having have worked for CDFI and sat at the table when these applications would come in from developers, and it was well, there's not enough experience. No. Well, there's not enough experience. No. Well, there's not enough experience. I, and I would say I feel like this is why we're here, right? Isn't this what's in our mission is to put this capital out the door so that more people that are starting this work can do the work. So it's a weird conundrum, and I think all CDFIs at some point find themselves a little bit off mission in that way, and it's frustrating. It's super frustrating.
Yeah,
I think I really want to talk about kind of as we near the tail end of this thing. I really want to think about just the deals and just the renovation, the preservation of these properties, and then the capital stack. What does that look like? The capital stack for preservation as opposed to and renovating these properties. Are you saving money over ground up? Are you doing the good work times 10 by preserving these as opposed to ground up? Talk a little bit about that capital strategy and capital stack.
yeah. Well, in general, preservation is cheaper, greener, and faster than ground up construction, which is why it would be more advantageous for us as a society to invest more dollars into preservation,
Hmm.
as opposed to just ground up. We do need both, but preservation has advantages, and we're not pouring enough into it.
Right.
That's my soapbox first.
Yes. Cheaper,
Second,
greener. Yes. Love it.
yes, yes. The capital stack varies widely. There's depending on how you do the deal. Some people have found a
Hmm.
model where they can um, kind of rinse and repeat. A lot of it is going to be dependent on what municipality, because when you're doing preservation and affordable housing in general, you rely on subsidies a lot. And every municipality is going to have different subsidies. Charlotte, I know they have a program for NOAA deals, just allowing a group of investors we know, they're just consistently churning out deals. Like they're doing numbers because Charlotte has a particular way that they subsidize deals that makes it very advantageous. Not a lot of places does that in that way. Georgia doesn't have that same kind of system or setup that you can
Hmm.
just do numbers. South Carolina has a setup that allows you to pretty much eliminate taxes by partnering with a nonprofit, even if they only have like 1% ownership.
Right.
And I know a group that's able to rinse and repeat deals in South Carolina and do it that way because they have a structure. In Georgia, we don't have that structure. So even we have like major developers, and
Right.
every deal they do looks different from a capital stack perspective because there's not really a good rinse and repeat type of model.
Hmm.
So where you got to look at different funding sources. So like for us, like for instance, our last deal, we were able to assume a home loan that was already on the property with a 1% interest rate, and that was about
Okay.
19% of the capital stack. Then
Hmm.
we got senior debt that was about 4.68 million. We got bridge debt with a tax credit takeout because we're applying for tax credits, which will
Right.
ultimately buy out that initial bridge loan, and then we'll buy out our investors as well. Then we syndicated 2.3 million in equity plus co-invested ourselves. So that capital
Mm-hmm.
stack had four layers with the senior debt, the bridge loan, the
Mm-hmm.
assumed loan of 19%, the equity, and then our co-invested equity. You may have a deal that is gonna have some kind of like it's gonna have senior debt, it's gonna have um a tax abatement, which isn't really part of the capital stack, but it does make a huge difference in how you fund the deal. And it's going to have
Right.
stipulations. Then you may
Mm-hmm.
have some mezz debt from a CDFI. You may have some impact equity. So there are equity groups that, most of your private equity groups are going to want to see returns that are higher than what a retail investors want. So like
Mm-hmm.
retail investors going to want minimum 13% IRR, usually like 15% plus. Private equity is going to want high teens, so like 17 to 19% or more, because they have to be able to make their spread and then give a return to their investors. But
Right.
there's going to be impact funding where it may be equity funds, but they only require or only want a 10% IRR because their funds is impact based as opposed to just capital return based. So
Mm-hmm.
there's different ways it's going to look. So it's going to vary depending on the deal. And just know with each layer of funding, if it's any kind of mission driven funding,
Mm-hmm.
each layer is going to have some kind of stipulation or something that's going to say you need to meet XYZ requirements, whether it's like an affordability restriction
Mm-hmm.
or some kind of renovation, energy efficiency, whatever it is.
And so with all of that, we know you mentioned it a couple of times, compliance, right? And paperwork. Who does that paperwork for you all? Do you outsource that? Do you all burn the midnight oil doing that yourself? How does that work for you all?
So as far as compliance on the property we own, our property management company does that for us. We hire a
Uh-huh.
third party property management.
Hmm.
As far as like the work for the applications, we'll do that or hire a third party depending on what it is. Like for structuring, like a part of your tax credit application for in-place properties, you're gonna have to do relocation because you're gonna be
Hmm.
redeveloping the whole property. So if you got people in place, you got to have a plan to relocate them during the renovations. We'll
Hmm.
bring in a third party that specializes in doing that. Same thing
Okay.
with like market studies and anything else, we bring in third party. But as far as most of the paperwork, we'll just do that ourselves for the application.
Hmm.
And it's usually not too bad, especially if it's like your second or third time applying, which is pretty
Yeah.
common. You don't, you apply once, doesn't work, and you apply again.
Right.
Hold on.
Yeah, you
Yeah.
definitely do. You definitely do. It's going to be a few rounds. Like I hate to be the bearer of bad news and people don't often understand that when it comes to these projects.
All right, sorry, I got 12
I'm good.
o'clock is calling me.
That's okay. So with that, we'll loop around and kind of wrap this up. Any closing thoughts? Anything on
Um,
this? What do you want to tell people? Get out there and preserve. Like what's the thoughts?
yeah, so I would say affordable housing is needed. It's very much needed, and there everybody knows it's needed, but it's very much a challenge to do. So I think it's worth getting into. The benefit is you got a lot of there are resources you could tap into. You're able to eliminate a lot of competition when you move into affordable housing, but just know that it is a challenge. It is something that you got to be very patient with. If it's something that's important to you, just be willing to fight that good fight. Be patient and leverage, be resourceful. You got to leverage resources in this business through relationships, funding opportunities, market knowledge, and then also just the human aspect, being empathetic. A lot of that takes you a long way in this industry. So if it's something that's important to you, just be willing to do that, make the sacrifice, and know that the rewards you're gonna get, there will be financial rewards, but there's rewards even beyond that that separates you from, just other market rate investors. So that would be my thing. Just be ready for the challenge, the uphill battle, because it's coming. You just
But you
gotta stick
can
with
make
it.
money, right? You
You
can make
can
money
make
doing
money. Oh,
this.
it's lucrative. It's lucrative. You just
It's
gotta get
lucrative.
there. Yeah.
See, that's what I wanted you to say that too. It's lucrative. You can make money. You just have to get
You
everything
gotta
in order
build it. Yeah.
first. Listen, friend, we've spoken off and on over the years and over the last year, and I truly appreciate you and the work you're doing. And with that, I think I will say good day to everyone. Thank you for your time. Thank you for joining, and I hope you got a lot of knowledge out of this. Perfect.